The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Great to see you back for another week of Property Investing Matters. I'm Margaret Lomas, and tonight regular guest Simon Pressley from Propertyology is back. And this week he has his special brand of property investing guidance. And of course, we have questions to answer as well. So expect a great show this evening. Now, remember that you can join in on the show with a question of your own at any time that you like, either by emailing your question straight to me at pam@mypropertytv.com.au or posting it in a comment on any of my Facebook posts, or you can even DM it to me directly from Facebook. As I said, Simon Pressley from Propertyology is with me tonight. Now, Simon has been awarded for excellence in the real estate industry with consecutive state and national awards as Buyer's Agent of the Year. Now, in 2015, Simon became only the third person inducted into the Real Estate Institute, or the Australian Real Estate Institute Hall of Fame. Tonight, we're going to be looking at Australia's post-COVID transference of housing demand, and I'm very interested to find out more about what Simon has to say about that. Let's welcome Simon to the show. Hi, Simon. How are you going?
Good, Margaret. Thank you for having me back.
It's great to see you here. Of course, you know, we've been talking for many months now about what will happen with COVID. Nobody seems to really know. Obviously, we've never been here before. We've never seen a pandemic. So nobody really had a roadmap on how to navigate the real estate industry. But let's put the current boom that we have seen into some kind of perspective. And I know that, again, you've kindly sent me some graphics to take us through that. So I'm going to bring up that first one, and if you want to tell me all about it, what it means, and explain it to us, please.
Yeah, my pleasure, Margaret. Well, we're 1 month short of when this boom started. To be specific, it started in October 2019. So 6 months before COVID arrived is when this property boom started. The last 12 months, we've sort of seen most of Australia, their individual property markets has increased by somewhere between 10% and, believe it or not, 30% in just a 12-month window in time. So what we're experiencing at the moment is by no means normal. For the last decade, there are lots of locations that were flat out seeing 10% growth across 10 years, let alone 10% in one 12-month period of time. The softest markets in Australia at the moment, I say soft with a tongue in cheek, but Melbourne and Adelaide are probably the softest, but they're no means poor. But relative to the rest of Australia, they're probably the softest. The strongest markets include the Northern Rivers region, so places like Coffs Harbour, Ballina, Byron, Kingscliff. All of Tasmania is on fire there, not just Hobart, but all of regional Tasmania. And then probably Sunshine Coast. They are the three strongest regions in all of Australia, but everywhere strong. As you can see in this graphic here on the far left-hand side of this graph, the green columns there represent the combined capital city change in median house price. So we've got the 8 capital cities stacked on top of each other. And you look at the height of those columns on the far left compared to any other time in the last 30-year period, we actually have the second biggest boom in Australian real estate history that we're in right now. But the orange line there shows what our population, Australia as a whole, is what the rate of population growth has done over that same 30-year period of time. And it's the lowest it's been, not just in the last 30 years, but the lowest Australia has seen for more than 100 years. We've got to go back to World War One.
It is interesting when you look at that graph, because the highest ever population growth coincides with the lowest ever, almost the lowest ever property growth. But I guess that could be explained by the fact that the property growth often lags a little bit behind the population growth.
Yeah, well, I guess that there's a lot more to housing demand than raw population growth. We've written lots of reports about this over the years, and I guess what we're seeing right now is, yet another piece of proof. We got very small population growth rate, but all-time, all bar one period of time, record high Australian property prices. Housing demand is really a measurement of buyer activity, and of course, if there's a growing population, those people need to live somewhere. But there are plenty of us who buy properties without moving towns or cities, and each time we transact in real estate, either as a buyer or a tenant, we're adding to demand. And I guess that's what the topic of tonight's discussion, isn't it, to talk about this transference of housing demand.
Interestingly enough, and coincidentally, just this morning, I posted on Facebook talking about housing demand and the fact that it isn't a strict question of supply and demand. People always think of pure economics and think of the fact that if supply is big, demand is usually filtered out, and therefore we don't get price growth. And if demand is really big but supply is small, we get this price growth. But it's a lot more complex than that with property, because, as you say, we do turn over property even whether our population is growing or not. Someone might buy a new property every couple of years, but one of the bigger, I guess, drivers of demand in Australia, at least, is both the supply of finance and the cost of it. So when we're seeing these low interest rates and plenty of money around and a bit more accessibility to money, then we do find that we get that demand, and particularly if that's coupled with a time when rents are skyrocketing and it becomes significantly cheaper to buy than rent.
Yeah, absolutely. And this, I guess, is where the economists got it all wrong when COVID arrived, and we were told the international border is going to close, so they immediately added 1 + 1 and thought it was a simpler answer as 2, thinking no population growth means no property price growth. But it's never ever been as simple as that. Humans are not robots. We're not homogenous. We all want different things. We all like different things. We all earn different incomes. We all want to live in different styles of properties. We all live in different parts of Australia. So it's never ever as simple as what's the total sum of our population and then subtract that from the total number of dwellings. There's lots and lots of components to demand and lots of components to supply.
Simon, you've been referring to the transference of housing demand. Can you just explain to me what you mean by that?
Well, there's a lot of things, I guess, in any given period of time, forgetting COVID, there's always different reasons why different people want to change dwellings, either to rent or to purchase a property. But if you think of some COVID-specific things, we've got record low interest rates. You quite correctly just touched on that. So what that means is someone who wishes to transact in real estate, the cost to do so is a lot less than what it would normally be. We've got this really strong equal and opposite reaction at the moment. If you've got a graphic there, if we can pull that up to explain what I mean by that. We've probably all heard of Isaac Newton's law of motion, meaning, for every reaction, there's an equal and opposite reaction. Well, I think what we've got at the moment with COVID and each individual's response to COVID is the property equivalent to Isaac Newton's law of motion. Some people have been intensely affected psychologically by COVID. If they've been locked up for a long period of time, there's some things that they really don't want any more of, and there's some things that they really want to gravitate a lot more towards. And others have been very adversely affected financially because of COVID. Not many people want to sit around in the same town or city and remain unemployed. So they're looking to change where they're living or downsize a property because of how they've been affected by COVID. And there's been plenty of other people who've never had a stronger earning capacity in their life than now, and that's primarily because of COVID. So things that we don't like and things that we do like. We don't like being locked up. Humans don't like being told we can't do things. We don't like confined spaces much anymore. We don't like financial uncertainty. These are things, I guess, we just took for granted pre-COVID, but now with this GM's been with us for 18 months, we've got some really strong reactions. Now, how that affects real estate directly from COVID, well, we've had a lot of people that have upgraded their family home, that they probably, now people upgrade their family home every year, but not everyone does. And there's been a much bigger volume of people increase or upgrade their family home because of COVID. They're spending more time in their home. If they have the earning capacity to afford a nicer home, they are transacting in property. So that's an example of demand, but it's got nothing to do with any change in population. It's just someone, because of COVID, wanting to live in a different dwelling. We've got a lot of people that are working from home and have adopted that permanently. A lot of these people never previously would have considered that that's what they wanted to do. And in doing that, they might want the extra bedroom. Or other people who have, I guess, adopted the permanent work from home have sort of decided that, well, now that I'm doing that, my home can be anywhere. If you're transacting and doing your job at a laptop somewhere, it doesn't matter where that laptop is. So some people have literally left town, not just relocated from, say, an inner city apartment to a suburban house, but they've physically left town. Another impact of transference of demand because of COVID is we've got expats. People have returned to Australia now, whether they're seeking rental accommodation or whether they're purchasing a home of their own, but that's something that's happened because of COVID. And apartments is another thing. There was a strong appetite for some people to live in a city in a densely populated part of town, but when you're forced to be locked up in your home, people want more space.
Absolutely. Yeah, look, I've got to admit that I'm probably coping better than some people by mere virtue of the fact that I'm living quite near the beach and I can sit out on my balcony and look at that beach, and I don't feel like I've been kept from it so much. So I don't have that overwhelming desire to break the rules and get out to the beach, because at least I can look at it. And every day I do realize that there are a lot of people who don't have that opportunity, and lockdown is very different for those people. But talking about lockdowns and talking about work from home, and I know that this is not something, again, that any of us can really forecast, but with people staying away from the CBDs, what do you think will be the longer term impact on property maybe closer to those cities, apart from the fact that, yes, I acknowledge that you've already talked about people wanting space around them, but maybe more specifically commercial property as well? Are we going to start to see those inner city commercial properties lose value, be less in demand? And are we going to start to see our cities less urban development taking part in our cities?
Yeah, we've definitely seen some trends already, and we're going to look at some of those trends. But I think some of these trends, it might take a few years for us to really see how COVID has affected Australia economically and property market. There's going to be some enormous winners coming out of COVID economically and in property markets, and sadly there's going to be some tragedies as well, but I don't think that we've actually seen the full scope of that. Sydney and Melbourne, just in the first 12 months of COVID, Margaret, we just look at the internal migration figures, for example. The latest ABS data takes us up to the end of March, and both those two cities have had a net decline of 32,000 people just in 12 months alone.
Are we looking at your graph for this now, or not just yet?
No, I'll come back. To that, but some of that is related to how COVID has affected big congested cities, and Sydney and Melbourne will always be Australia's two biggest cities, but unfortunately with a germ, it breeds most in congestion. And the CBDs alone of both Sydney and Melbourne pre-COVID had about 500,000 jobs just in the city centre, not talking about the whole city, just in the CBD. Now, with COVID, and obviously this is still going on now with both those two big cities in lockdown, the restrictions are such that a lot of people with those jobs cannot go where they used to go to do that job. So if they can work from home and earn their income, then that's obviously what they're doing. But there are certain jobs that you can't do that. So if it's a clothing outlet, if it's a cafe, if it's a university, if it's a hotel. Now, there's been some wonderful support packages when COVID, first hit, but you can only survive on a drip for so long. And we are going to see, unfortunately, tens and tens of thousands of jobs. Many businesses have already closed in the CBDs and on the city fringe. But behind those closed businesses is the business owner, and so how COVID affects them, not only they lost their business, but their ability to pay their own mortgage. So they're either downsizing to a more affordable home, they're leaving town, or in some cases it's worse than that, it's bankruptcy. Their staff, they've lost their job. The cleaners, the suppliers of whatever type of business we're talking about, they no longer have the revenue that was coming from that business that's closed. The commercial landlords, you touched on commercial property. So just one business closing in a CBD has widespreading tentacles, and you're talking CBDs that had 500,000 jobs in each of those cities. So this is going to be a couple of years before we see how this fully plays out. We think of inner city apartments. We've seen a lot of them go up in our big cities over the last sort of 20 years, and those who were living in them were primarily because that's where they went to work each day. Well, their job might not be there anymore, or they may not want to be living in a confined space anymore. So that's going to affect property investors who own the inner city apartment. Their rents are declining, their vacancy rates are rising. There's going to be some distressed sales, I believe, in inner city apartments in coming years. So they're the casualties, but there's going to be a lot of winners as well.
All right, well, look, let's go now to those trends that you were speaking of, and I want to start with rent trends, and you're saying there's a crisis at the moment. So let's have a look at that graph on Australia's rental crisis, and if you could talk us through that.
It's a real paradox when we look at these two graphics. We've got the green representing everywhere in Australia with the exception of Sydney and Melbourne. So Sydney and Melbourne are the blue there, which is about, round figures here, it's about 10 million of our 26 million population. But what we've got there is on the right-hand side is the vacant dwellings. So there's about 2.5 times the number of rental vacancies in just Sydney and Melbourne compared to all of Australia. So our two biggest cities have never had a bigger problem in terms of vacant rental properties, and our 6 capital cities plus our 200 individual regional towns and cities have the complete opposite problem. There is nowhere to live. There are people with plenty of money, good jobs, secure jobs, that are living in cars, that are living in tents, that are sleeping on someone's couch until they can find somewhere to live. So now some of this was sort of unfolding before COVID, but the problem has been accentuated since COVID arrived because of how it's affected people in different ways. The pressure on rents is such that we are in a report that we produced only about 3 months ago, Margaret, we identified 34 individual regional towns and cities where their asking rent has increased by at least $1,500 per year since COVID arrived. Some of those locations, annual rents have increased by between $5,000 and $7,000 per annum. These are just standard houses. We're not talking luxury homes or anything like that.
Absolutely. Certainly seeing it here on the Central Coast. Let's go now to the internal migration statistics that you've got for us. And if you can explain what we're looking at here with our internal migration, I'm just going to bring that graph up for everyone to have a look at. And if you can talk us through it.
Yeah, so I've broken, I guess, up into 4 main segments there. Greater Sydney, the bottom line there, the blue line. Internal migration in Sydney has always been a negative figure. Each and every year there have been more people leave Sydney than arrive in Sydney. But since COVID, and for a few years before COVID arrived, that trend has accelerated. The gold line there is Melbourne. Melbourne's internal migration was typically neutral for most years. There's a couple of years there where Melbourne's population might have increased by 1,000 or 2,000, and that's it from internal migration. But it's lost 32,000 people just in the last 12 months. And there's no coincidence. That's that really strong lockdown that Melbourne had of about 4.5 months or something last year, and another one now. Been a lot of commentary suggesting everyone's moving to Brisbane. Brisbane is the maroon line there. Brisbane's internal migration has been progressively increasing over the last few years, but it's been very consistent now for 3 or 4 years. So it's absolutely a furphy. In my hometown's Brisbane, that's absolute furphy to suggest that everyone's moving to Brisbane. Some people are moving to Brisbane, but no greater rate than what Brisbane has seen for quite a few years. The green line is where all the action is, and there we've bundled up each of those, all of those 200 individual regional communities. That has always been a positive figure. Every single year, well before COVID, there's been more people move away from the capital cities to various parts of regional Australia than going in the opposite direction. But since COVID, there's been this insatiable appetite for nature, for space, for less congestion, for lower risks of future lockdowns. So that trend is heading up in a big way. We've had 145,000 people over the last 5 years alone, Margaret, that have left capital cities and relocated to various parts of regional Australia.
Simon, there are some commentators, and I believe that there's a little bit of potential truth in this, who believe that once we do get past the health crisis and we're living with COVID and everything's normal again, that a lot of those people who have made the decision to move out to the regions will change their mind and move back to the cities. People who are just city livers and who realise that, it's lovely to be in the regions for a little while, but after a while, when there's not a good movie house to go to or not much in the way of restaurants, you yearn to get back into the city. Do you think we'll see that happening in the next couple of years?
Yeah, I've heard those comments, and it's a load of crap, to tell the truth, Margaret. Can't be stronger than that. I think there's always been a segment of Australia's population that perhaps they've only ever lived in a big congested capital city, and their perception of regional Australia is a grossly inaccurate one. They tend to lump all of regional Australia into one, as if it's one location. So that's like comparing Broken Hill to Byron Bay to Cairns to Busselton. I mean, they're all completely different. The graph we just looked at earlier showing the trend for internal migration through regional Australia has been a positive one every single year for as far back as data goes. And I'd suggest that what COVID has done for some people who've lived in, let's say, Sydney or Melbourne for most or all of their life, they have wanted to go and find somewhere else to escape lockdown, and they've been pleasantly surprised with what they have discovered. And I'd suggest once you discover those beautiful things, if you've gone to the effort of selling your former family home, moving away from friends and family, establishing new connections and buying a home somewhere else, you haven't done that for practice. Yeah. So if anything, I think the trend to go to regional Australia will accelerate, not go back the other way. People have already made that big decision. They've still got those connections in the capital cities. And as they continue to share their stories about this newfound life they've got, I think it's more likely they're going to drag some of those loved ones with them.
Absolutely. What about job opportunities, though? What are we looking at in terms of what's on offer in terms of jobs in some of those regions?
Yeah, I'll put a graphic together here because, again, it's one of those grossly inaccurate misconceptions that a lot of capital city folk have about regional Australia. The reality is there are jobs in big, small and medium-sized locations. People wouldn't be living there if there wasn't jobs there. And if there wasn't enough jobs there, their property markets would be weak because local economic conditions has always had the biggest influence on property prices. The best performed property markets in almost every single year, not just now, have been outside of our capital cities, partly because their economies are strong. If we have a look at what the change in the number of jobs directly before COVID, so in February 2020 compared to now, I put this chart together yesterday. This graphic here, the red column shows the national average. The dark green columns are what the capital cities have done in change of jobs, and the blue are some regions. So you've got 20 locations there, the best, the biggest 20 cities in Australia, and you can see that it's a fair figure to suggest that all the jobs are in the capital city. That's never been an accurate statement before COVID, and never will be at any stage.
Well, certainly plenty to think about there, Simon, and lots of reasons why people shouldn't be just dissing the regions. You and I have always talked about the fact that there's always been some opportunity in regions all the time, whether it be COVID or whether it be any other time. There's always been some great regional and smaller capital city opportunities that people seem to miss. They seem to always think that Sydney and Melbourne tell the only story about property investing, but you can have a good sound property investment in a regional area or in a smaller capital city, and over time it's going to perform pretty well for you if you hang in there for the longer term.
Yeah, absolutely. I think what a lot of people, I mean, no one means to do this, Margaret, but a lot of people just have an inaccurate perception. So they've never been to these locations, whether it's a holiday or the business or indeed to live there. So I guess we form a perception just based on what we believe to be true. But investing is not about what you like or what you think, because you're buying a property not for you to live in. A big bunch of other people live in that property that you buy as an investor over the next sort of 10 or 20 years. So it's got nothing to do with you as the owner. It's more, you really do need to understand economic conditions and housing supply volumes at an individual town and city. And I said it before and I'll say it again, there are 200 individual regional towns and cities throughout Australia. There's a lot of them, so we can't just blanket them all into one big box.
Absolutely. Well, you probably have some questions of your own, and if so, you can get them to us right now. And you need to do that because not only will you get an answer, but you'll also get the book prize. All you need to do is email your question to us, and at the end of the show, each sender of a viewer question that we answer will receive a free copy of Investing in the Right Property Now. All of my books are usually available in most good bookstores, but if you have a question for the show, you'll get a complimentary copy. Just email pim@mypropertytv.com.au or pop your question into a comment on any one of my Facebook posts. When we come back from this short break, we are going to start to answer your questions for this evening, and we'll also continue our discussion. So there's plenty more time to come on the show. Don't go away. We will be right back. Welcome back. You're watching Property Investing Matters on My Property TV. I'm Margaret Lomas, and tonight I'm chatting with Simon Pressley from Propertyology. We've been talking about property in Australia post-COVID and the transference of housing demand. But it is time to get to our viewer questions, and those questions that we answer tonight will receive a copy of my book, Investing in the Right Property Now. So if you'd also like a copy of this book, or any other book that we normally give away on the show, make sure that you send an email to me with your question or pop it on a post in my Facebook posts. Let's take a look at our first question, and it comes from Chris. And Chris asks, hi Margaret, are you able to discuss the pros and cons of putting down a 10% deposit versus a 20% deposit when purchasing an investment property, excluding the potential for paying LMI for 10% deposits, which I'm already across? Are you able to also provide an insight into the ability to extract equity easier and faster with either? Simon, it's a debate, isn't it, that often goes on whether you should stay safe within that 80% range and potentially take that little bit longer to acquire property but pay the price with the LMI, or go to 90% and then go a bit more quick with buying your property.
Yeah, look, I really love Chris's question. Thank you for sending it in. It's a very good one. There's absolutely no failure at all for paying lenders' mortgage insurance. Obviously, if anyone's borrowing with less than a 20% deposit, mortgage insurance is applicable. It doesn't immediately imply that paying mortgage insurance is more risky. The APRA speak of the world, that often suggests that. But I would argue, let's look at a scenario, someone who's got, say, buys a $1 million investment property with a 20% deposit. I would argue that that's actually more risky than buying two properties that are collectively worth $1 million, but you have a 10% deposit in each. Why I'd argue that the second scenario is a lot less risky. Firstly, all of the capital has been spread across two completely different locations rather than being all the eggs in the one basket, one very expensive property. So if there's a downturn in that one market, if you've broken your money up into two different assets in two different locations, you're not going to be disadvantaged by the downturn in both locations. And the cash flow is much stronger. Where some people get into trouble with debt is they haven't stress tested the ability to manage the cash flows. The cash flows will always be stronger for a more affordable property than a big expensive property. So if paying mortgage insurance means that you can get into an asset quicker and build a bigger asset base, provided you are stress testing your cash flows, I'd do that every day of the week.
And look, Simon, I definitely agree with you that buying the 500,000 is definitely better than buying the $1 million property for a lot of reasons. I will point out though, if you've got 20% for $1 million, you've got 20% for two $500,000 ones as well. So you'd still have that same 20%. But if you only have 10%, I think the risk would lie greater with a 10% deposit on $1 million property than on 10% on two $500,000 properties, because we often see at those greater rates of buy, we see a greater capacity for that property to go up and down in a shorter period of time. And what I mean by that is when we start getting into the higher ends of markets, we're seeing the top end of the population buying those higher end markets, although $1 million is not the highest end in Sydney, of course. And we do see that when there is economic stress on the entire country, it's those more expensive properties in markets that tend to be more impacted by changes in values, those short-term changes. My biggest concern, Chris, with using the 10% is that while property is going wonderfully like it is now, the biggest problem that you have at 10% is that, particularly with stamp duty costing so much, you're going to be paying you're bringing in 10%, presumably plus the costs, but you're financing that property right up to almost its value by the time you take into account the fact that you're also paying on that stamp duty. And then if you end up having to sell in the short term and that property hasn't gained any value, you've got less margin for error, less margin to pay out those selling costs that you've got to pay out, and more chance that if you need to sell, what you owe on that loan is more than what you can recover in total out of that property. That's my main concern with going to 10%. You do have to consider the mortgage insurance. I know you say not considering that, but you do, because the closer you get to 90%, the more expensive proportionately that mortgage insurance is. It's 6 times more on a 90% lend than it is on an 85% lend. And so it's a considerable amount of money. And on a property worth $700,000, you could be paying $40,000 in lender's mortgage insurance. That's a lot of money on top of the $40,000 or $50,000 in stamp duties. There's $100,000, and once you start getting your 90% loans, you don't really have a lot of equity there. You've got a good capacity to lose money if you have to sell in the short term. So providing you're confident that you can ride short-term vacancy issues, short-term value losses, and that you won't need to sell for some other reason in the short term, be it a breakup in a relationship, a change in your financial circumstances, or any of the other things that could happen to you in that time, then I don't see a problem with the 90% to gain your equity and your property sooner. But if any of those other things might apply, I think you need to stay safe, stay at the 80% where you've where you do own some equity, and if you need to sell in a hurry, you can at least cover what's owing on that loan. Let's have a look at the next question, and it comes from Sashin, and I don't know if that's how to explain it, but it's quite a long question, Simon, so bear with me. Hi, Margaret. I'm a regular viewer of your show, and I'm simply loving it, which is great. I bought my first property in 2009, and I started living in it as a principal place of residence until I bought another property in November 2012 as a PPR and converted the first property from PPR to investment. In 2021, I built a third property as a PPR and converted the second property to the investment. Now I'm thinking of moving out of the third property, only living for 6 months and moving into a rental. I'm planning to sell the first property and maybe the second property in 24 months' time. Now moving on to the questions. Firstly, the questions when that comes up is, how does the 6-year rule work with each property? Can I claim a 6-year rule with all 3 properties when I sell? And what is the best strategy to use to minimize capital gains tax events when selling all properties? So Simon, it's really a tax question, but how about I just I'll grab the first 2 questions and I'll leave the third question to you to answer.
You can run with the tax part of it, Margaret. I'm keen to talk to Sashin about this more as a strategy rather than the capital gains tax part of it.
All right, well, let's go with the capital gains tax. First of all, how does the 6-year rule work with each property? Well, the 6-year rule doesn't work with all of your properties. It only works with one of them. So you can't have a 6-year rule going in place the whole time. You can have them on different properties if they're not occurring at the same time. So to put it simply, because you confuse me, I guess, a bit with all your dates, if you own a property and you move out of it and you buy another property to live in, then you have to decide which one has the exemption. The other one can get the 6-year rule. Sorry, not the other one. So you decide which one has the exemption. If it's the one you've just moved out of and you're leaving your exemption there, then the 6-year rule applies to that. But if that happens, then the property that you're living in when you move out is starting to accrue capital gains tax from the second that you purchased it. Then if you sell that and move on to a third property, you can still only have one with the exemption. You might want to be leaving it in place over the first one. If it runs out of its 6-year rule, you might want to move it to the second one or move back in and invoke another 6 years on that first property. So long as you understand that only one property at a time can have your principal place of residence exemption. Given the period of time that you're talking over, it's likely that when you sell all 3 properties, at least 2 of them are going to incur capital gains tax. The third one that you're living in now, if you're moving out and renting, then at least you can leave that principal place of residence exemption in place. If it gets to 6 years, you can move back in and have a reset of that 6 years and get another 6 years before you need to sell. And you can do that as many times as you like. But because there's only one property at a time with a PPOR, you've got to decide which property has it and when it ends for that property and moves on to the next. And you need an accountant to help you do that. Very complicated. Simon, what strategies can he use?
So, Sachin, what you've done is what a younger version of myself I did too, and an overwhelming majority of property investors do the same. I want to encourage you to see property and the investment property as a financial instrument in a similar way to how a share investor would consider stocks on the stock exchange. Most property investors I would describe more as a collector rather than an investor. And what I mean by a collector, they only ever consider buying properties in exactly the same town or city that they are living in. The purpose of investing is a financial outcome. Key to giving ourselves the best chance of the best financial outcome begins by considering 100% of our options. For us as property investors, that's 8 capital cities and 200 individual regional locations. We need to focus less on the bricks and the mortar and the individual property. If we're just focusing on that, it is just pot luck that we happen to be living in a location at the time we can invest and the outlook is good. If we are a creature of habit investor, let's say 10 years ago, we did what you've described there, Sachin, and we lived in Perth. Those 3 properties are all worth less today than what we originally paid for them. So we need to open our minds up to all of Australia and start to understand local economic conditions, local housing supply. These are the key things for making really good investment decisions. It's got nothing to do with it's your hometown or not.
Good advice there. And so just as a final little bit of advice, you ask what can you do to minimise the CGT when you sell it. Well, there's not a lot you can do because you're already in the situation. You've already been buying them and living in them and moving on. You've already got a situation where you've got 3 properties and you have to work out where that PPO exemption sits and how long for. I think one property you bought in 2009. So even if you left it in place there, it would have run out on 2015 anyway. So that's going to incur capital gains tax from now on. One in 2012, it would have run out on that one as well. So you've got to remember those things. But one thing I can tell you is that if you sell them in different years, you will minimise your capital gains tax, because capital gains tax works exactly like income tax. So you work out the gain using a formula, you get to halve it, but then it taxes onto the top of whatever you earn that year elsewhere. If you sell all 3 at once, you're going to have a lot of that gain in the highest tax bracket. But depending on your own income, if you sell 1 each year, you may be able to reduce that income just by a little bit.
Good advice.
This next question for you, Simon, is right up your alley, and it comes from Chad. And Chad asked the question, "Hi, Simon. I've been quite interested in Townsville for a while. Does this area have a long-term opportunity, and is the return worth the hold?" By which I think he means, will he be getting a good enough rental return to cover his expenses to wait for whatever is going to happen in the future? I would suggest that's what he means.
Yeah, okay. Thanks for the question, Chad. Very, very good one. Good to be talking about something different other than our 3 capital cities. I put together a graphic for the viewers. Perhaps we can have a look at that while I'm just giving a general overview for those who aren't greatly familiar with Townsville. If we drew a horizontal line and we cut Australia in half, every location in the top half of Australia, Townsville is actually Australia's biggest city. Overall, it's our 14th largest city, population of about 200,000 people, comparable in size to Geelong, Wollongong and Hobart. Very poorly performing property market for the 10 years ending 2020, but that said, so was most of Queensland and Western Australia over that same 10-year period of time. Townsville strengthened quite a lot over the last 2 years, as you can see from the green line in this graphic, which is the capital growth rate. It's running at double-digit growth pace today, and one of the contributing factors for that is what you see there in the blue line, a consistent reduction in the number of properties listed for sale. This is what I call the pressure valve. Things that we like about Townsville: it's got a very diverse economy. It's Australia's defence capital, but other very important industries to its economy. Got a strong education presence, manufacturing, agriculture, natural resources are very strong. There's a lot of economic development initiatives that we like about North Queensland, whether it's a lot of renewable energy projects. There's a lot happening in the manufacturing space, universities expanding. There's a new military base being constructed, about $1 billion. Cost of housing, a quality house that will be somewhere between $400,000 and $500,000 in Townsville, so it's very affordable. Housing supply is tight. You'll get rental yields of about mid 5% range. Insurance in Townsville is higher than plenty of other parts of Australia, although it's not Robinson Crusoe there, but the strong rental yields will more than compensate the higher annual insurance expenses. So I'd actually put Townsville in the top 20 locations in Australia in terms of their market outlook, and I'd have that top 20. None of those would include our 8 capital cities.
That raises a very interesting question then, Simon. Which is your top?
Can't tell you that, Margaret. That's the thousands of dollars of questions that people pass. We're buying in 10 locations at the moment. 10 different locations at the moment we're actively buying in, and I don't mind sharing Townsville is one of those.
Okay, excellent. Well, that's good to know for Chad, at least. And now our final question, unfortunately for you, Simon, is another capital gains tax question, but I think we can deal with it fairly quickly because it's along the same lines. Hi, Margaret. I listen to your show regularly. I wonder if this is a friend of Sashin, because it sounds like almost the same question. We didn't get the name on the bottom of this one somehow, but I think it's Ahmad or something like that. My question is that I bought a property in 2011 and I started living in it. In 2013, I bought another property and I converted the new property to my principal place of residence, and obviously his old one, kept it as an investment, and I always tell people not to do that for other reasons, which I'll explain in a moment. Now I'm thinking to sell my first property. I can get the prorated discount on the capital gains tax, 6-year rule from 2013 to 2019, and only pay tax from 2019 until it's sold after calculating 50%. That's correct. I got a valuation when I moved out. Also, if I sell my second property in the future, will I get principal place of residence exemption if I already claimed it on my first property? So very, very quickly, you're not only paying capital gains tax from 2019 until it's sold. That's not how it works. You're paying capital gains tax on, you've got to work out the difference in the valuation between when you moved out in 2013, which is I think when you moved out, to what you sold it for, but then there's an exemption made for the 6 years. So it's prorated, but it's from the valuation 2013, not from what it would have been valued in 2019 when your 6-year rule exemption ended. So that's the difference in what you're suggesting. As far as your second property, you don't just get one PPOR exemption in your life. You get a PPOR exemption for every property you live in, but you can only claim it on one property at a time. So if you own 2 properties at one time, it has to go on one, and it can't go on both. So that's the difference in what you're asking. Simon, what I wanted to point out when you were talking to Sashin about the strategy of, not necessarily living in a property and then moving on, and then living in a property and then moving on and turning them into rentals. You raised some really good points that I think is very important for investors to understand. The first one is that what you're saying is it's great to invest widely, but the point is where you used to live may not be at the top of that tree. You say you've got 20 areas that you think are top 20 in Australia. Well, just because you owned a property and you liked that property and you think it makes a good rental doesn't mean it's in that top 20. It's in the bottom 10 of your list.
And I use the term that might be foreign to some people. I said you need to see property as a financial instrument. So the share equivalent of what Sashin has done, could you imagine someone who, let's say they work for Woolworths and they're a share investor, not a property investor? That does not mean that they should buy shares in Woolworths. They've got the whole stock exchange to look at, and they need to understand what influences the value of shares and consider all of those companies on the stock exchange. Where they happen to work has got nothing to do with where they should invest their money. And property investors need to think exactly like that as well. Where you live, the town or city that you live in, is irrelevant to where you should invest. Totally irrelevant. I'd actually argue if you own a family home, the last place you should be considering to invest in is your hometown. Because you're doubling down and putting more capital in that one market. So that's an easy thing that all investors can do, is to look at locations everywhere other than their own hometown, which is not how people think as property investors, Margaret, is it? But it's how we want them to think.
And Simon, to make that strategy even more compelling, one of the things that people never think about is this. When you live in a family home for a while, it's likely that you're paying P&I repayments and you're paying it down. So it's gained value at the same time that you've paid off some of that loan. If you keep it to move into another property, you probably give the bank both securities and borrow enough money to buy that new property. Your biggest loan is probably going to be on the property that you live in. And your smallest loan is on the one that you rent out. And yet, the one that you're renting out, that the interest on that loan is tax deductible and the interest on your own home is non-tax deductible. That can cost people, I think I did the calculations once, $10,000 to $15,000 a year alone in additional costs and losing of tax benefits. And if you think about that 15,000 as the equivalent of $15,000 worth of property equity, over time, that money could snowball for you and do more for you in other markets. So it's rarely smart to turn a property which has a lower debt into an investment property wherever it exists, and then move on and have a bigger debt on your own home. And so many people don't think about that, Simon.
No, spot on, Margaret. We don't teach financial literacy anywhere in society, unfortunately. There's a lot of hard-working Australians who do their best, but their knowledge is lacking, and it's simply because we don't teach it. So, put a lot of good knowledge around you to make up for the flaws that are within the society that we're raised in.
And that's why people watch this show. Although it is time for us to wrap the show up now, but we will be back again in a few weeks. And joining me on the next show is Damien Collins from Momentum Wealth in Perth. And it'll be great to see how Perth and Western Australia is faring right now, straight from the horse's mouth, so to speak. If we answered your question tonight, please send an email to PAM@mypropertytv.com.au with the subject book prize. Tell me your name, address, and which question you asked, and your book will be winging its way onto you. Thanks so much, Simon, for being here again and for sharing all your wonderful knowledge.
My pleasure, Margaret. Great to chat to you again.
You can grab Simon at propertyology.com.au, and I know he would be only too pleased to help you out. Here's all my contact information. You can see it all there. I'm not going to read it. You know what it is. And I'll see you back here with our next show, so be sure that you don't miss it. Meanwhile, get more of your questions through the week to me so that I can be sure that we answer them on the next show. And I'll see you then.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello there, I'm Margaret Lomas. You might remember me from my Sky News Business Property Show days. My company is Destiny, and we've taken the 25 years experience that we have in property advising and created Property Match. For the first time anywhere, now you can be matched with the investment property most suited to you. Give us a call today or visit the website mypropertymatch.com.au. Why not leave it to the people who know property investing the best? Destiny.
You can teach me your game with no reason. Make me feel like a lonely friend. So call me now. Come on, babe.